Hi team. Today we're diving into a question a lot of people have. Is paying off your mortgage early really the final step to financial freedom? Because here's the truth. It's not just about paying down debt. It's about what comes after. Now, let's start with why so many people aim to pay off their mortgage early. It's not just about the numbers. For a lot of us, it's about the peace of mind, knowing you own your own home outright. It gives you the flexibility, fewer bills hanging over your head, and it feels like freedom. Now, let's talk about the impact. Paying down your mortgage is like getting a guaranteed return equal to your mortgage rate. Now, right now, that is around 4 to 5%. It's a risk free win. But on the flip side, if you could have invested that money, perhaps you could have got 7 to 10% over the same time horizon. But here's what a lot of people don't consider. Once you put that money into your home, it's not liquid. Now, technically, you can have access of overpayments on some mortgages, but only if your lender allows it. This is the borrow back feature. Now, in practice, most people remortgage every 2 to 5 years, which basically resets the clock and locks those overpayments in forever. So while it is possible, it's not the same as having £20,000 sitting in an ISA or an investment account that you can access at any time. So now we're going to be looking at a couple of examples. So a typical mortgage in this country in the UK is £250,000 based off the average house price of around £280,000. Now over a 25-year term, 5% interest, the monthly repayments are around £1,460 a month. Now imagine you got a lump sum of £20,000. That's an amazing situation to be in. Now what could you do with that? You could put that straight into the mortgage and pay it down sooner. What impact would that have? It would save you around £43,450 of interest saved. Take about 3 years and 7 months off your mortgage. Amazing. Now, how does this compare to taking the same money and putting it into an investment? Now, if we make the assumption that this investment returns 7%, which is net of inflation using historical market returns of 10%, then in the future, it could be worth £108,000. That is £45,550 more than the interest you could have saved. Now, on one hand, you've paid down your mortgage sooner, you've got a guaranteed return, you know exactly what it's going to save you. Whereas the other, it could return a higher return of double what you had saved off your interest. And that is the choice that people have to make. Now, another common scenario is overpaying a mortgage a few £100s per month. Now, what can this do? There are many mortgage calculators out there on different websites you can go and look at and use and choose different values here. But for this example, we're going to stick with a £250,000 overpaying £200 per month. Now, what would this save you in interest? Would it save you again around £45,000, which is amazing, and take 5 years and 2 months off your mortgage? Why? Because you're paying £200 per month. It saves 5 years off your mortgage, off a 25-year mortgage. So you're effectively paying a mortgage for 20 years. £200 per month for 20 years is about £40,000. So you've paid over £40,000 into paying off your mortgage quicker. It saved you £45,000 of interest, taking 5 years off your mortgage. Again, a brilliant situation to be in and something that many, many people do. You know exactly where you stand because every pound you put into your mortgage goes straight off balance, your equity increases, and you save 5% on that balance that you've paid off. However, the alternative is to take that £200 every single month and put it into an investment. Now, if we assume again 7% return, which is net of inflation using historical market returns for 25 years, what could this give us? Now, it could speculatively give you £150,000 back, which is amazing. You've put £60,000 in, which is £200 per month, 300 periods over 25 years. Now, what does this give us? It gives us £152,000 back. Now, we've put £60,000 in, we've gained £91,000, meaning £92,000 back in terms of profit. Now, this is obviously assuming market returns historically are those that are going forward, but speculatively, this is a much higher return or much higher benefit than paying off the mortgage sooner. The other thing to bear in mind is, are you playing offense or defense? Now, you can't take away the nice feeling of paying off your mortgage early, that security of not having to pay any more monthly payments for your mortgage. But one thing you have to remember is if you had £152,000 in an investment, paying 4%, which is quite common now in any kind of bond dividend stock, any kind of annuity you can get, that would give you about £600 every single month. Now, if you've been putting this £200 into an ISA every single year, you shielded it from any kind of tax. So that money, that £600 every single month, is tax-free. And this is where the choice becomes. Do you pay it off sooner and know you've got a guaranteed return? Or do you put it into investment knowing you could get future revenue and get cash flow forever? So what's the answer? Well, for most people, a balanced approach is best. Think of it as mixing some offense against defense. You pay down some mortgage, you get that peace of mind, but you also invest to grow your wealth. Now, this way, you have a bit of both security from a lower mortgage and growth from your investments that hopefully outpace inflation. So talking about inflation, what is it? Well, money in the future is worth less than today. So inflation effectively shrinks the real value of your long-term debt. For example, if you were borrowing £100,000 today, it would be worth around £46,000 in tomorrow's money in 25 years' time, assuming 3% inflation. And that's why mortgages and buy-to-lets can work in your favour, because effectively the debt erodes while rents and salaries go up. But the flip side is that inflation also eats away at your cash savings and your investments, so they need to beat inflation. Now, overpaying the mortgage reduces debt, but it doesn't create income. So you look wealthy on paper, but your monthly cash flow stays the same. Investing the same amount, if done wisely, can start producing income long before, whether that's through dividends, rent, or side ventures. Now, income is what gives you options, not just a lower balance. That said, overpaying your mortgage feels amazing. It guarantees certainty, but investing the same amount, £200 a month, could start paying you £500 to £600 a month in passive income later down the line on the same investment. One gives you peace of mind, the other builds you freedom. Now, the right choice will depend on whether you value security now or flexibility later. In the end, being mortgage-free feels fantastic. It's a great milestone, but it's not the end game. The real goal is having flexibility to choose. Now, if you found this helpful, make sure to like and subscribe for more insights on balancing your financial future.